All right, well, the U.S. added 303,000 jobs in the month of March. Well, that was well above the street's expectations. Now, Citi saying in a recent note that they expected the job market to weaken with just 150,000 jobs added in March, leading to 125 basis points of cuts this year, almost double what the market is currently pricing in. So where do things stand following this higher than expected jobs print that we got out this morning? We want to bring in one of the economists behind that call. You have Andrew Hollenhorst. He's Citi's chief U.S. economist. Andrew, it's great to see you here. So first, just your reaction to the print that we got out this morning and whether or not that changes your base case for the Fed and the degree of the cuts that you are expecting this year.
Yeah, this was a much stronger than expected jobs report. Like you said, stronger than our forecast, stronger than consensus forecasts. I don't know that it changes that much for the Fed at the end of the day, or that we should be changing our forecast at Citi, and I'll explain why. From the Fed's perspective, this is exactly the kind of jobs report that they want to see. Like you explained, very strong job growth, but not a pickup in inflationary pressure to the extent that it would concern Fed officials. What we've seen from the Fed recently is a real tolerance for somewhat stronger wage growth, somewhat stronger price growth. To your point, year-on-year inflation readings, year-on-year wage growth readings are coming down. That's going to keep the Fed encouraged that we can actually run this stronger job growth, and it's not going to lead to a reacceleration in inflation. Now, is that something they should be worried about? I think they should be. But if you've listened to the recent Fed rhetoric, they're really pushing a narrative that the potential of the U.S. economy is greater and that potential job growth is higher so that you can have these jobs numbers and you can still have the Fed on course to cut rates later this year. We haven't heard from Fed officials after the report. I think when we do, what we'll hear is that they still think they're on that path to cuts.
Well, you bring up an interesting point that Mohamed El-Erian kind of mentioned this morning, saying that the Fed is sort of acting like, I'm extrapolating here, but like a sports commentator. They're just commenting on the data as it comes in. They don't have this central thesis driving them. But it sounds like you might be picking up on some sort of central thesis from them that you might disagree with. Can you spell that out for me a bit more?
Yeah, I think where the Fed has been, and I would agree with Mohamed El-Erian on this, is that the Fed has been very, very reactive to each data point. And that kind of happened throughout 2022, even into 2023, as the inflation readings just kept coming in stronger than expected. And what they're trying to shift to now, I think, is a kind of consensus around the idea that, in their view, interest rates are restrictive at these levels. And if they don't begin bringing down interest rates, that will slow the economy later in the future. So they need to start bringing interest rates down now to prevent that slowing that could happen in the future. I think that's where they are as a committee. But there are two risks to that, like you point out. One risk is that you cut rates too early and that reaccelerates inflation. And we have a lot of signs that inflation is really not getting back to 2%. It looks a lot stickier around 3%. There's also a risk to the other side of the mandate, the employment side of the mandate. Now, you're certainly not seeing it in the jobs figures today. Very strong hiring, a low unemployment rate. But when you look at some of this data in detail, you see things like the unemployment rate that, yes, it's low, but it's risen almost half a percentage point. And when you get this kind of gentle slowing in the labor market, especially when you might have some labor hoarding that's going on, people had trouble hiring, so they're reluctant to fire now. Firms are reluctant to engage in those layoffs. You can have a quick shift towards layoffs. So you really want to be careful with this labor market data. Yes, in terms of where we are today, very strong. In terms of where we're going, there's still a lot of open questions.
Andrew, if the Fed does not cut 3 times or cut what your base case is 125 basis points of cuts here before the end of the year, what is that then? Talk to us just about the risk that that poses to the economy, the likelihood of a recession, the weakness that we could see in the jobs market, and then further what that would tell us just about the overall pressure for the U.S. economy going forward.
Well, this is what's so difficult for Fed officials to manage is you do have these long and variable lags, is the term that always gets used, in terms of the effect of monetary policy on the economy. So interest rates are high. They've been high for some time. Inflation has come down, which means real interest rates have actually increased. That is exerting more and more of a restrictive power on the economy. At some point, that is going to slow the economy down. if you just leave interest rates at a restrictive level for too long, then you will slow the economy perhaps more than what's necessary to bring down inflation. On the other hand, if you look at the data today, well, the activity data are all holding up, jobs data is holding up, and inflation is running above target. So, just based on kind of the data that we got this morning, for instance, you would say, why cut interest rates? There should be no rush to cut interest rates. But if you think about where we might be going, then that creates an argument for cutting interest rates. And the Fed is trying to get that balance exactly right. That's their job. That's, of course, what they're going to try to do. The reality is that historically, central banks do not get that balance right. Sometimes it's impossible to get that balance right. It may be that there is no path to 2% inflation that doesn't involve unemployment going higher.
So this brings up a really difficult point then about how challenging this is for the Federal Reserve. And we've been talking about how the road to 2% would get harder as it went along. And Jay Powell certainly talked about that as well. But given what you just mentioned, is there a reason for them to cut with inflation still looking hotter than expected and this jobs print as of this morning?
Yeah, so I mean, if you look at the most recent data on inflation, it really hasn't been encouraging of this idea that inflation just slowed down. At the end of last year, that story looked a lot more encouraging, where you had 6-month core PCE, and I think there was maybe a little bit too much emphasis on that one measure. That had gotten down below 2%, and Fed officials were looking at that, and I think they were really thinking, maybe we really have the soft landing here. Maybe we don't want to say it publicly, but maybe we've kind of really achieved that. And now it's just a question of kind of, when do we actually get these cuts going? If we've landed the economy softly, then we can start to normalize interest rates. There's a much bigger question now about whether inflation is really coming down. I think it has become a lot more clear to markets, to Fed officials, to analysts, that there is a last mile problem here, that it will be difficult to bring inflation down. And by the Fed's own forecast, they have inflation closer to 3% at the end of this year than to 2%, at least on a core PCE basis. Yet they still plan to cut in that scenario. And that's this difficult balance between supporting employment, but also trying to be attentive to your price stability target.
Yeah, and Andrew, speaking a little bit more about that last mile in terms of taming inflation, you've got wage growth, yes, improved a bit when you talk about that drop from what we saw the previous month, but still strong. You've got oil prices. Maddie was just discussing this massive move up that we've seen in crude and Brent. Is that going, do you think, to contribute to the difficulty here for the Fed in trying to tame inflation and almost keep inflation moving sideways here for some time?
Yeah, what we're seeing with goods inflation, with oil prices, that could be a real headache for Fed officials. The way we got down to that 2% inflation on a 6-month basis, where we were at the end of last year, was largely through goods price disinflation. And now that we're starting to see some of these potential supply chain disruptions again, and just this move higher in energy prices that we've seen most recently, we shouldn't expect that disinflation to continue. And if anything, you could have some upside risk to goods. And on the other hand, the domestically determined inflation, particularly in the non-shelter services, that's going to be very responsive to wages. And I think you described the data exactly correctly there, that yes, wage growth has slowed, but wage growth is still running stronger than it did pre-pandemic. Of course, wage growth is a good thing for employees. The issue is when that wage growth feeds into higher prices from firms, and you're kind of stuck in the scenario where wages are running higher and prices are running higher also. And that's where we are right now.
Sounds like not a lot of reason to cut other than the Fed already telling us that they were going to. Andrew, thank you so much for joining us. Really appreciate it. That was Andrew Hollenhorst, Citi Chief U.S. Economist, on all things jobs data and more.